Carvel, and I'm the Chuck in the Markets Up Chuck. And, there's a lot being written over the weekend about, where the markets rally, overdone, the stock's going to collapse now, and everybody constantly fesses about the stock market. And as I always said, it's really a market of stocks, not a stock market. And I did want to show an example today of FLIR Systems. This is a really interesting company. It does thermal imaging, and it does it for things like, defense, military, aerospace, and a lot of other markets. But this company is the world leader in thermal imaging. It's also used in things like energy controls in buildings and et cetera. But it's really a terrific little company. But I do want you to notice the relationship between earnings and market price over this company's 18-year history here as a public company. As you can see, from the period 1993, earnings were reasonably okay and flat, and the stock price, which is the black line, followed the blue and green line, which is the earnings lines, and the price-earnings ratio line. Had a slope in earnings here, but then look what's happened over the last 8 or 10 years. I want you to notice that earnings have really accelerated dramatically, and look at the times where the market overpriced this stock, and then of course it came back to reality during the recession, and then got undervalued. But what's really interesting is this company really hasn't run up as much as a lot of stocks have. In fact, if you look at the forecast, the company has a good balance sheet, less than 20% debt. It's forecast to grow at 20% a year. It's trading right now at around 16 times earnings, which makes it a very attractive long-term hold based on these charts and the fundamentals. Currently selling at a very low price-to-sales ratio. So as always, this tool helps us screen companies and find companies that look attractive. FLIR is an example of a company that really hasn't participated in the rally, and yet their earnings have been exceptionally good. Frankly, right through the recession. If you look at just the last 10-plus years of the company's history, their 18-year average has been 17.9%, but more recently their earnings growth has actually accelerated to over 24%. So even a 20% forecast is really not that high. And on this basis, this stock would normally, if it was trading at its normal price-earnings ratio, be a $33 stock that you can buy at $20. There still are a lot of bargains out there if you're willing to look. You got to do your homework, do your own research. But this is just another example of a company that I think still has a lot of room to run, assuming everything we see in this picture is correct. This is Chuck Carvel saying thanks for listening, and talk to you again tomorrow.